All right, so this is the Financial 15 section of our webinar. So if you're just joining us for this section, then please hit the subscribe, like, and notification button so that you receive notifications when we have new videos or new topics. So in today's Financial 15, we're going to talk about when not to convert to a Roth IRA. And you might be surprised to hear me say this because many times, and including on one of my recent podcasts or webinars with David McKnight, who's really a thought leader in tax efficient planning in the country and probably worldwide at this point. But I said to Dave, you know, the Roth conversion tool we have is a real gift from the IRS, because all we have to do is decide what tax we want to pay today. And if we know the tax rates are going to be higher in the future, it can make sense to potentially pay tax at a lower rate today, convert those assets to Roth IRA, and never had to pay that tax again. So that sounds really good, but there are times when you should not do that. You should not take advantage of that tool at all, or maybe it's your time is done with your conversions. So let's talk about first, what is a Roth conversion? So what is a Roth conversion? I'm going to explain that using our buckets. So those of you who have followed us for some time recognize these buckets. You've got taxable bucket, tax deferred bucket, and your tax advantage bucket. So your taxable bucket, you know, you've got a certain amount of money that you should keep in here. Most experts agree that this should be 6 months to 1 year of expenses, not income, but expenses. And we know that this is a taxable bucket because every year we get 1099s for interest, dividends, short-term capital gains, long-term capital gains. Sometimes we get K1 income out of here, and all of those types of reports that I just told you about, the 1099, all that equals tax. So you've got to pay that tax every year, whether you reinvest your dividends, whether you take out those dividends, and you got to pay capital gains when you liquidate positions or your mutual fund liquidates and rebalances for you. But there's a lot of limited control with that taxable bucket. So we like to keep that amount as low as possible. And again, usually 6 months to 1 year of expenses is what we want in this taxable bucket. Then we have your tax deferred bucket. So that's over here. So that's your IRAs, your 401ks, 403B plans, simple. We talked about simple IRAs a second ago in our weekly webinar section. What else? SEP IRAs. Just think of it as anything that you promised to pay tax on later. You get a tax deduction or didn't pay tax on that money that went into this bucket, but then you have to pay tax when you distribute from that bucket, and you pay in the form of what's called ordinary income tax. So it's just like you earned it. So that fills up your tax bucket, and you pay tax wherever you land on there. Then we have the tax advantage bucket. So we know something is tax advantage when it doesn't cause your, you don't pay federal tax, you don't pay state tax, you don't pay capital gains tax, and it does not cause your Social Security to be taxed. So there's only two things that are truly tax-free, and one is a Roth, anything Roth, Roth IRA, Roth 401k, Roth conversions. Of course, there's requirements with all these things that you have to keep up with, you know, the 5-year rule and whatnot. I mean, and there's details within Roth requirements, but generally, if you've any qualified distributions from a Roth IRA, Roth 401k, are tax-free. And then the other truly tax-free vehicle is cash value life insurance, or properly structured cash value life insurance. Some people refer to this, and my friend David McKnight refers to this as a life insurance retirement plan. But today we're going to talk about Roth. So what is a Roth conversion? Now that we know how our buckets are structured, what is a Roth conversion? So the IRS code allows for us to take funds from this tax-deferred bucket and convert it. It's actually a distribution. It's a distribution from your IRA or your 401k or your simple or SEP. That is, but it's simplest to do from your IRA. So let's just stay with that. So it allows you to take money from your pre-tax account and distribute it and pay tax, and then it then is recharacterized or lives in your after-tax right? So your tax advantage, your Roth. So now any growth you'll have from that conversion, as long as you've met the qualifications and requirements, will be distributed tax-free. So it is actually a distribution that you're allowed to redeposit into Roth. There's only two ways to get money into Roth IRAs, one and Roth 401ks or retirement plans. One is contributions, and two is conversions. Contributions have many requirements and restrictions. Some of them have to do with income limits and phase-out levels. Some of them have to do with whether you have earned income or not. If you're talking about Roth IRAs, and 401ks have some restrictions as well. You can only put in so much. But conversions, they tell us that in the tax code, we can do as much or as little as we'd like. You could convert $1 million a year. You could convert $1,000 a year. And if you have $100 million, well, geez, you could even convert that total amount if you wanted to in 1 year. There are no speed limits on this. The determination is how much tax you want to pay in the transfer, because the tax has to be paid as you're crossing that bridge from tax deferred to tax-free or tax advantaged, or as my friend and mentor Ed Slott says, from forever taxed to never taxed. It's really forever taxed to never taxed again. But the question is, how much and how much tax do you want to pay? So really, really great tool. I think you'll agree that if we have this tool and if we know, well, geez, our tax rate seems high today, but it's probably the lowest that we're ever going to see in our lifetime. And we know the taxes are going to be much higher in the future. And in fact, our math tells us that your average middle-class American is going to be in the 40 to 50% tax rate, probably by about 2030, plus or minus a couple of years. And yes, that's gone up. It used to be 40 to 45%. It's the range is higher. And if you have several $1 million in your IRA, you're likely to be plus this. But if we know taxes are going to be significantly higher in the future, and they just must be, then it can make sense to pay your tax now, take the appropriate amount of money out of your traditional IRA, redeposit it via conversion to your Roth IRA or Roth 401k, and then never have to pay that tax again. All sounds great. You've got to be careful, because sometimes it does not make sense to convert to a Roth IRA or a Roth 401k or other Roth plan. So now we understand what a Roth conversion is, right? So we talked about that. The benefits we talked about: forever taxed to never taxed again. Once you move that money to a Roth IRA, that's your benefit. You're never taxed again on that money. You can withdraw the principal if you want to, and you don't pay tax on that, of course. You don't pay tax on any contributions, on any conversions. And if you meet the requirements of the 5-year rule, you don't pay tax on any growth. I get asked that question all the time. But what about the growth? I had an attorney who said, no, you got to pay tax on the growth of it. No, you don't. As long as you meet the 5-year rule, you don't. The 5-year rule is very complex prior to age 59 and a half. It's very simple after 59 and a half. So don't worry. Pay attention to it, but don't worry about it too much. There are also ordering rules that make it very, very challenging to violate that 5-year rule. But we want to overcome some of these risks. We want to overcome tax rate risk. And that's what I talked about. Taxes being much higher in the future. Your average middle-class American to be at 40, 45, or maybe even 50% or higher effective tax rate. RMDs. RMDs are forced out. That's a required minimum distribution. Once you reach certain ages, age 73 right now, you must start taking money from your IRAs, your 401ks, anything that lives in that tax-deferred bucket. The IRS determines exactly how much you have to take, and if you don't take that money, they penalize you up to 25% of what you should have taken out. And if you think 25% is a lot, just a couple years ago, that was a 50% penalty, 50% penalty. Roth IRAs and Roth 401ks now have no RMDs. So you get to determine. You have more control over your money because you get to determine how much you want to withdraw from your retirement plan. Isn't that a good idea? So you can eliminate having to take out more than you need. Cash flow. We see that with proper structuring of Roth conversions and other tax-efficient strategies, you actually end up with significantly more money and more cash flow. Most people. that we see. Many people we see end up with significantly more money and more cash flow, in later years of retirement, especially by using tax efficient strategies. So you get to spend more money. If it's a goal of yours, you could get to leave more money to your heirs. But most people are concerned about their needs in retirement, and time again, we see that there is increased cash flow and increased assets by using tax efficient strategies, including Roth conversions. So there's some of the benefits in estate planning. Geez Louise, this one's often overlooked, but if you're going to leave any money to the next generation, or if you're listening to me and you think that you're going to inherit a significant amount of money from an IRA, for heaven's sakes, have a conversation with whomever's going to leave that money to, your parents, a rich uncle, whoever it might be. Talk to those people about potentially converting that money from traditional IRA to Roth IRA before they pass away, because it's going to be a forever tax headache for you. If you inherit an IRA, you cannot convert those funds. You don't have the option of converting those funds. So the Roth IRA, Roth 401k, anything Roth is an absolute gift, again, from an estate planning point of view. So a lot of benefits to it. But when do we want to consider not converting? We don't want to trigger an unnecessarily high tax rate. So what does that mean? Well, follow me over here. These are our tax charts that we have from the Ed Slott Group. And you can download these from our website. If you go to the slot corner on our website and go into that resources, I think it is tab, you scroll down and you can download these. You just have to put in your email and you can download. So you'll see that married filing jointly and single filers are listed here. And you'll see that the top of the 22% bracket stops for married filers at a taxable income amount of $201,050 for 2024. For just 2% more, you can cross into the 24% bracket, and you're at $383,900. So we often say, well, geez, just for 2% more in tax, we can convert a lot more money. Obviously, the numbers are very different for single filers. They're basically cut in half, or they are cut in half. And that's one of the reasons that you may want to escalate Roth conversion strategy if you're a married couple, because one of you is going to pass before the other. So once that one person is gone, that one person left inherits all your money, or whomever passed, and then they've got a much higher tax rate, likely just because of their filing status. So it may make sense to push all the way up if you're a married couple into $383,900 and take advantage of that 24% bracket. For some people, it may make sense to go into the 32% bracket. For some people, it may be 35. For some people, it may be 37. For most people, it's not. For most people, you can probably get the work you need done right around 24. Depends on your risk tolerance, tax rate, risk tolerance. You might want to push up into the higher levels. Sorry, I was cutting that off a little bit. But time and time again, I have people who come to me and they say, I read some books and I watched some videos and I'm really excited about these Roth conversions. And I already started doing the work. So I say, that's great. Tell me about what you've done. And he said, well, I converted $1 million last year. Well, okay, some people may have to convert $1 million a year, and if they have a significant amount in their IRA, that might be the right number. It's not typical, I'll tell you that. So people get excited about it and they say, okay, I just want to get this over. And suddenly they jump up into a much higher tax bracket than needed to be. Some people, it makes sense to be at 37. There are reasons sometimes that, if the future of your tax rate is 50 plus and you're converting at 37 and there's no road for you to convert at 22, 24, then that might be the best option for you. But that isn't for the majority of people. People get excited, and it is exciting when you learn. I remember I was excited when I learned about these strategies way back in 2012, and I started implementing them. And you can get overrun with it. But be really careful not to convert at unnecessarily high tax rates. So I hope that makes sense. Charity. This is a big one that most people don't consider.